In 2022, the UK pension system hemorrhaged over £500 billion, and you were told a politician's reckless tax cut was to blame.
But the math proves that collapse wasn't a political accident at all. I mean, it was a highly precise engineered wealth transfer.
You probably view financial crises as, random black swan events, sudden shocks to the system, government incompetence, terrible luck. But holding on to that belief completely blinds you to the reality of the architecture.
Because the system is functioning as intended, to legally siphon assets from structurally weak holders to aggressive capital operators.
So in this deep dive, we're tracking a £500 billion crime scene. We're looking at who took the money, the mechanisms they used, and how they got away with it, drawing directly from the raw data of the UK liability-driven investment crisis.
Let's unpack the official story first, the facade everyone knows. September 23, 2022. Chancellor Kwasi Kwarteng announces a mini-budget.
He promises £45 billion in unfunded tax cuts. The markets panic at the fiscal irresponsibility. Government borrowing costs skyrocket. The pension funds blow up. The narrative is incredibly clean.
A rogue politician crashed the economy. But structural data dismantles that narrative completely. The crisis was mathematically inevitable, regardless of that budget.
Inevitable.
For 15 years, pension funds had been transformed into derivative time bombs using something called LDI leverage, liability-driven investment.
Hold on. Liability-driven investment. Derivative time bombs. These sound like terms designed to make people stop asking questions. Why were boring, supposedly safe retirement funds suddenly acting like Wall Street day traders?
Regulatory pressure colliding with a low interest rate environment, pension funds have future liabilities. They have to pay people decades from now.
And when interest rates dropped effectively to zero after the 2008 financial crisis, safe government bonds stopped generating enough yield to cover those massive future payouts.
Regulators essentially forced the funds to mathematically match their current assets to their projected future liabilities. To close that massive gap, the funds used borrowed money through repo agreements to artificially multiply their exposure.
Let me ground this. A repo agreement is basically a short-term pawn shop loan for banks. You hand over a safe bond, get cash in return, and promise to buy it back tomorrow. You're saying regulators approved a system where pensions pawned their own assets to buy more assets, over and over again.
They approved the entire architecture. It functioned with minimal collateral buffers. Any sharp tightening of monetary policy was guaranteed to detonate the system. The fuse was already lit.
How early are we talking?
On July 1st, 2022, that is nearly 3 months before this infamous mini-budget, the investment consulting firm Mercer sent a direct warning regarding unprecedented liquidity strain in these funds.
3 months before the politician even stepped up to the microphone.
The Bank of England had only hiked interest rates by a mere 1.5%, and the structural integrity of the pension system was already failing. The monetary authorities ignored the signal.
Blaming the mini-budget is like blaming a dropped match for a forest fire, while completely ignoring the people who spent 15 years systematically soaking every single tree in gasoline. The match was irrelevant. The forest was designed to burn.
And when the fire inevitably started spreading, the Bank of England stepped in. Between September 28 and October 14th, they purchased £19.3 billion in government bonds, known as gilts.
On paper, that looks like a rescue operation. The central bank acting as the buyer of last resort to save the pension funds from total collapse.
The intervention did not save the pension funds. They still took catastrophic losses. The total LDI market shrank from £1.5 trillion down to £0.7 trillion.
So who did they actually save?
The central bank's intervention actually functioned as an emergency liquidity window for a completely different entity, the primary dealer banks.
Are you seriously suggesting the central bank intended to bail out the middlemen at the expense of the pensions? Or was that just a chaotic byproduct of a panic where the banks happened to have the best vantage point?
Look at the transaction mechanics during the panic. Primary dealers are the giant global investment banks acting as the exclusive gatekeepers for government debt. During those crucial days, these dealers forced the dying pension funds to dump £25.3 billion in bonds.
At what price?
At a massive 7 to 10% discount from their fundamental value. Simultaneously, the dealers widened their bid-ask spreads.
The baseline fee they charged to facilitate a trade.
They widened it by 5 times. It jumped from 0.5 to 2.5 basis points in a matter of days.
The pension funds are bleeding out. desperately needing to sell assets to cover their margin calls, and the middlemen holding the door suddenly quintupled the exit fee.
They bought the distressed assets from the panicking pensions at a severe discount, and then instantly dumped those same assets onto the Bank of England, which had publicly guaranteed it would buy them.
That is classic institutional front-running. The market maker exploits the gap between a desperate seller and a guaranteed buyer backed by taxpayer money.
A completely risk-free arbitrage for the banks.
Let's pause right here because the scale of that extraction is staggering. We are tracking a £500 billion contraction in corporate balance sheets. The primary dealers scraped billions off the transaction fees and the arbitrage. That is a massive haul. But it is just pennies on the dollar compared to the $500 billion that vanished. Money doesn't just evaporate into the ether. It moves.
It moves to global macro hedge funds, specifically funds operating aggressive short strategies against sovereign debt.
If the pensions bled that much cash out of their accounts to meet these margin calls, these hedge funds were standing on the other side, holding the bucket.
Consider O'Day European, managed by Crispin O'Day. Long before September, his fund had an astronomical 111% net short exposure against UK bet. They didn't just bet the broader market would go down, they targeted the exact 2050 and 2061 long-dated bonds that the LDI pension funds were heavily concentrated in.
They aimed directly at the structural load-bearing pillars of the pension system.
O'Day European recorded a 193% gain. Another player, Hadar Jupiter, managed by said Hadar, secured returns around 200% for the year by ignoring market consensus and leveraging aggressive interest rate trades.
How did they physically extract that capital?
They intercepted the direct cash flow through a mechanism called variation margin on interest rate swaps.
I need to translate that mechanism. A swap sounds complicated, but it is essentially like trading your fixed-rate mortgage for your neighbor's adjustable-rate mortgage. The pension funds were paying a fixed interest rate and receiving a floating rate. They did this thinking they were locking in safety.
The hedge funds took the other side of that bet. They paid the floating rate and received the fixed. The hedge funds understood the architecture was going to fracture. When bond yields went vertical, the value of those fixed payments plummeted.
The mechanics of the swap contract dictated that the losers, the pension funds, had to immediately post cash collateral, the variation margin, to the winners.
So when the earthquake hit, the hedge funds just stood there with a vacuum cleaner while the pension's bank accounts emptied out. They didn't even need to wait to sell a physical asset.
They vacuumed the cash directly out of the pension funds' accounts day after day as the market crashed.
And all of this capital was instantly and legally routed to offshore tax havens. O'Day's primary fund is the Cayman Islands Exempted Company, administered through a structure in Dublin, and Irish QIAF. Hadar Jupiter is also registered in the Cayman Islands.
The wealth extracted from the British retirement system passed through an Anglo-Caribbean offshore circuit, completely dodging UK fiscal oversight.
The flow of capital was practically frictionless.
There is a massive logical gap here, though. Sovereign bond markets are vast. To build a 111% short position, specifically targeting the exact 2050 and 2061 bonds that the pensions held, requires unimaginable precision. How did the hedge funds know exactly when and where to strike?
The answer sits in a 2025 Bank of England working paper. It exposes the structural information asymmetry. The primary dealers, the same banks we discussed earlier, control the flow of information because they see all the trades across the entire system.
They have the master view of the board.
In the build-up to the crash, these dealers paradoxically provided cheaper liquidity to the hedge funds, allowing them to build their massive short positions against the UK debt.
The toll keepers lowered the toll for the predators. Why?
Because the moment the margin calls hit the pension funds, those same dealers instantly choked the liquidity for the broader market. They raised the transaction costs.
They fueled the fire and then locked the exits.
The dealer syndicate absorbed the inside data from the speculative market, calculated the exact breaking point where the LDI portfolios would face forced liquidation, and orchestrated the pricing architecture to ensure maximum extraction.
They calculated the exact breaking point. They knew precisely when the pensions would be forced to sell, and they positioned the hedge funds to catch the fallout.
The timing was not a coincidence. It was a mathematical certainty visible to anyone controlling the order book.
Here is where it gets really interesting, because we have to look at the human cost. We are talking about private pension assets dominating defined benefit schemes. 9.9 million active and deferred beneficiaries. These individual pensioners, the people who work their whole lives, are the ultimate losers carrying the bill for this wealth transfer.
The data reveals a bizarre accounting paradox here known as the denominator effect. It completely alters the definition of who lost. Because interest rates rose so aggressively during the panic, the projected cost of paying out future pensions actually dropped faster than the value of the assets burning in the fire sale.
Hold on, I just want to make sure I'm fully grasping this because it sounds fundamentally broken. You have a massive pool of money, and it is actively on fire. You are losing billions of pounds in a forced market panic.
But because interest rates are high, the spreadsheet calculation for what you need to save for the year 2050 drops.
So the insurance company sends you a letter saying, your house burned down, but lumber is cheaper now, so your financial position has improved. That is an insane way to run a financial system.
The official terminology used by the industry is an improved funding level. The balance sheets presented an illusion of solvency. This specific accounting quirk triggered the next phase of the takeover. It allowed corporate insurance cartels to swoop in and swallow these pension plans whole.
The cartels being the institutional life insurers.
Legal in general. Roth say Pension Insurance Corporation. In 2023, following the crisis, the bulk annuity market absorbed an absolute record of £49.1 billion in assets. Corporations dumped their pension plans into the hands of these insurers.
It's just massive consolidation.
The massive £7.5 billion British Steel pension scheme was entirely integrated into Legal & General's portfolio.
The pensioners didn't lose their payouts immediately, but they lost their independent trustees. They lost control over their own collective capital. It was completely absorbed by massive insurance megacorporations.
The absorption went further. When the pension funds had to generate emergency cash to survive the margin calls, their liquid assets, the government bonds, were already burned. They were left holding illiquid assets, private equity, real estate, infrastructure. They were forced to liquidate these on the secondary market.
Selling a physical property or a private company takes months, sometimes years. If you have to sell it in 3 days to meet a margin call, you are going to take an absolute bloodbath on the price.
Specialized private equity secondary funds, entities like Collar Capital and Lexington Partners, stepped into the carnage. They bought up the growth and venture capital portfolios from the dying pension programs at a massive 24.4% discount. Distressed assets were taken at a 23.7% discount.
Almost a quarter off the price.
The total volume of these secondary market transactions hit an all-time high of $114 billion in 2023. A perfectly orchestrated feeding frenzy. The hedge funds drain the cash through the swap contracts. The primary dealers scrape the transaction fees and front-run the central bank. The insurance cartels absorb the remaining healthy portfolios using an accounting loophole. The secondary private equity funds scavenge the illiquid assets at a massive discount. After a wealth transfer of this magnitude, the regulators must have stepped in and dismantled the LDI architecture to prevent it from ever happening again.
They did not dismantle the system. The pensions regulator simply forced the funds to maintain a larger capital buffer, specifically a 300 basis point resilience test against interest rate shocks,
forcing them to hold more cash on hand.
It functions as a barrier to entry. This new regulation drove the smaller players out and monopolized the synthetic leverage market in the hands of the giant transnational asset managers who built the LDI architecture in the first place, firms like BlackRock and Insight Investment. The structure remains intact. The offshore routing remains intact. If the structure is still there and the leverage is still there, just with a slightly bigger buffer, where is the current vulnerability? What actually changed?
Because the funds were forced to reduce their overall leverage, they now require higher yields to meet their future obligations. To get that yield, they have shifted their collateral pools. They are increasingly using corporate bonds to back their derivative trades, an action explicitly permitted by the Bank of England in late 2022.
Corporate bonds are inherently riskier than government debt. If a corporation goes under, the bond goes to zero.
The secondary private equity syndicates we discussed, the funds that bought the assets at a 24% discount, currently hold $216 billion in dry powder, unused capital. They are intentionally holding this cash offstage, entirely outside the active market.
They're waiting for the next fire sale. What exact corporate credit shock are they waiting for to trigger the next engineered collapse?
That is the variable currently hanging in the air. The trap is reset.
This forces a complete paradigm shift in how we view financial history. The official narrative blaming Liz Truss and the mini-budget is not just a political talking point. It is the ultimate shield. It creates a convenient villain that allows the central banks to hide their massive supervisory failures. It protects the shadow banking architecture that generated these astronomical profits.
It legitimizes using taxpayer money to act as a liquidity backstop for global investment banks, all while claiming to save the economy from political incompetence. The consortium of monetary authorities and regulators have monopolized this historical narrative.
Concentrating the blame on fiscal policy obscures everything else.
It obscures the accounting standards and regulatory directive that forced pension plans to use synthetic leverage in the first place. It hides a £1.5 trillion shadow bank in plain sight.
You think your retirement fund is an investment, safely tucked away compounding interest for your future. Under current accounting rules, it is nothing more than collateral fueling a £1.5 trillion shadow bank. If the architecture hasn't changed, and the true culprits were rewarded with even more control, whose wealth is currently lined up for the next transfer.